I would be glad to, period. Go right ahead and send it, period. I just signed on to the lecture link to start the 10 o'clock review, period. Good morning, Dominic. Justin, how you doing?
Hey, good. Good morning. Thanks for having the lecture today, even though it's Veterans Day.
good.
Appreciate it.
I have to spend 10 seconds getting back to Ms. Alsheimer here.
Got it. Yep.
Let's see. Go right ahead and send it. I just signed into the lecture link, so leave me the hell alone for the next. No, I didn't type that. 10 o'clock review. Oh, okay. All right, gentlemen. I believe we're testing in chapter 6, 7, and 8. Is that correct?
I think we're doing, for the midterm, I thought it's through 10. I thought it's 8, 9, and 10.
Okay.
It's been our most recent.
I didn't realize. So we already tested 6, 7, 8, huh?
Right. And we struggled. That's how I'm going to try to make all the lectures. I'm just pulling up the syllabus on my other laptop here.
Yeah. No problem. I called up. I got to call up the right stuff here. Just give me a second.
Sure.
So we're doing 9, 10.
Yeah, I think, or it's 8, 9, and 10. At least it's 9 and 10.
I think it's just 9 and 10.
Okay.
Chapter 8 was fixed assets. I think we already did that, right?
Okay. Right.
Okay. I'll double check too, guys.
Right.
Okay. Okay, let me find the PowerPoint here.
Okay. Yeah. So chapters 9 and 10.
Okay.
110 minutes, 45 questions.
Okay. Any particular questions you want to start with, or you want me to go into a little spiel with the PowerPoint? Or
a little spiel would be good because, it's like these questions pop up, but it's like in the middle of a quiz when I'm just like racking my brain or the homework, but then I forget exactly what it was that I was struggling with.
Okay, we're talking in this chapter here. We're trying to introduce you to the world of present value. Okay, present value. Let me get rid of these other guys here. Don't need that. Don't need that. Okay. All right, here we go. Present value, and I have some other things I think can be rather helpful here.
Great. And then as I emailed some help with that FSA assignment, I just couldn't figure out how to get started.
Yeah. So. Yeah, in fact, I'm supposed to review that now too, but we'll hold off on that if you like.
But yeah, a little brief.
Yeah. Okay. Hold on. Time to share. Share. I'll sure be glad when we get back in the classroom.
Right. This is just, I've got a kid in high school. It just hasn't worked well doing that. Tele-ed.
Can you see the PowerPoint now?
Yeah. Yes, that looks good.
Okay, let's just make it a little bit bigger here. Okay, the main thing in this chapter here is we're going to talk about present value. That's really the gist of this thing, okay? You can raise money with equity by issuing stock to the public, or you borrow. And what we're talking about in this chapter is going to be a lot of borrowing and financing type things, huh? And
Right,
I'm
right.
pretty sure we know a current liability is less than 1 year and long-term liability. And this year, we already know about accounts payable, accrued liabilities, and this is really just from the prior chapters.
Right. But a nice little, yeah.
Yeah, yeah. You're not gonna have to do an accounts payable turnover until you do an FSA. I don't think there'll be anything on taxes, payroll taxes
Okay,
at
good.
all.
Okay.
I'm
Yeah,
willing
it
to
didn't seem like
I'm willing to stake my reputation on that, because Cornelia and I and others say if you really want to learn about payroll, we have a beautiful payroll course you could take.
Right.
Deferred revenues, that's the unearned revenue, you know that, and notes payable.
Right.
Keep in mind, you probably know this, whenever you see an annual interest rate, it represents an entire year.
Single. Okay,
So you
right,
have to prorate when necessary.
right. So if it's
Okay.
2 months, multiply 2, divide by 12. That
Well,
caught
yeah,
us up a little, caught me up a little bit when I was doing that
yeah,
annual
yeah.
and the
It's really,
example too.
it's really, yep, very easy to forget, especially go in a hurry. I was once behind a woman at a bank like 30 years ago, and she had in those days the interest rates were real high, and it was like 10%. And she put the money into a 1 month CD and demanded to know why she didn't get 10% instead of 1/12 of 10%.
Right.
Okay, refinancing. Here's something where you can just help yourself by spending 15 minutes looking at contingent liabilities.
Right.
And you as a lawyer could probably appreciate this. I know you're a
Right.
public
Well,
defender.
we're
I
always,
think.
yeah, we're always trying to kind of hedge.
Yeah,
Right.
yeah. If it's probable, if you think you're going to lose this lawsuit, and you can measure it, you have to record it at moment as a loss, as a liability. You have to debit it some kind of expense called legal losses or legal fees or something. Um, so know these rules. The only time you record it is if you know the amount and you know you're going to lose. You're very sure you're going to lose.
So for an example, and I think I did this on maybe the extra credit, is the gift cards. Home Depot knows that between 10 and 19% won't be returned. So is that a probable or more like a reasonably probable? I
Well,
mean, I know
that's not a contingent liability. That's a measurement of revenue. You know what we're talking about here? Lawsuits.
liabilities. Okay.
Lawsuits. That's all. That's what we're talking about.
There we go.
A company gets sued.
Right.
Okay. You go to your lawyer. We had a salesman come in to try us selling something, and the president of our company punched the guy in the nose and broke his nose.
Right. That's pretty probable that.
Pretty probable, pretty ridiculous. But yeah,
Right.
so that you would record as a liability. But if we don't know how much the damages will be reasonably, all we do is disclose it. Okay. So I guess the fastest way to pick this up is the only time you record a legal action against you is if you know the amount and you know you're probably going to, and you know you're going to probably lose. If you're not sure, all you can do is disclose. Somebody's suing us for patent infringement. We don't think they have a case, but we just don't know. And then if somebody sues you for using the name Dominic, some stupid thing, you can pretty much just ignore it. Okay. So just a couple of points on the test. Yeah, I think that's worth 2 or 3 maybe points on the test. Working capital, current assets minus current liabilities. Working capital gives us the amount of money we have left over for immediate use if we paid all of the current liabilities down. And it's a real important measurement most companies look at all the time. It's a measure of liquidity. If you don't have working capital, technically you're insolvent.
Right.
What's the difference between that and what was the current ratio again? Because I thought that was the formula. Oh, that was current assets over current liabilities?
Yes.
Okay.
Yeah, good question. I was just getting there. Yeah. Current assets minus current liabilities equals working capital. And if you divide current asset by current liabilities, that's your ratio. Okay, 2 to 1. So you got, if it's 3 to 1, you'll have $2 left over after you pay every single bill. Okay.
And if you're like 0.9, that's bad. That's when you're working.
Well, yeah, you want it to be, obviously you want it to be above above one,
Right.
because otherwise you're technically insolvent.
Right.
You could argue out of business, but you don't want it so high that you're just hoarding money either. You want to have, you want to use that money if you're lucky enough to have a lot, you know?
Right, right.
So
Like Apple Computers, I think has some massive, like, 110 billion or something in cash, but
big, yeah, getting off topic just a little bit, but I like to do this one real quick. One thing that will really help an economic rebound when we come out of this pandemic is companies are hoarding cash. They've been doing it for about 15 years now. They've been scared ever since the depression of 20 years ago. Hi, Nicole. How you doing? Nicole is with us. Say hi to Dominic. Say hi to Justin. Long-term liabilities. We know this, okay? Long-term liabilities. Here, they're just getting you a hint on bonds, okay? Big people borrow from banks, insurance companies, pension plans. I don't think we need that. Now, here's something we want to talk about a little bit, because I'm sure there'll be a few things on the test here. When you lease a piece of equipment, it's either called an operating lease or a capital lease. If it's an operating lease, it's pretty simple. You debit lease expense, or you debit machine, whatever you're leasing, copy machine, okay? You lease a copy machine from Xerox for $200 a month for 3 years, right? And every month you debit $200 lease and credit cash. And then at the end of those 3 years, Xerox picks up the machine. It belongs to them and you're done. That's an operating lease. That's expense. That goes on the income statement. Now, a capital lease is a totally different ball game. And companies love to play games between capital leases and operating leases, at least from where I used to, in my experience, okay? A capital lease goes on the balance sheet. It's a balance sheet. And it has a very specific set of criteria that make it a capital lease. And these things down here, you just need to understand. If it's an asset, say with a 5-year life, and you're leasing it for 4 years, that makes it a capital lease. That means you're going to debit an asset. You're going to debit machinery or something every month or whatever it is, and make the payment. No expense. If the deal is such that at the end of the lease, Xerox says, you keep the machine, that makes it a capital lease, okay? The third one is if you have a sweetheart deal at the end. Xerox says, look, at the end of 3 years, give me $20 for that machine. It's probably worth $100. If it meets any of those three criteria, you are forced to put it into a capital lease, meaning you're not getting the benefit of an expense on the balance sheet, okay? And then the fourth one, if the present value is 90% or more of the fair market value, then that makes it a capital lease. But those first three are the key ones there, okay? So operating lease, it's an expense on the income statement. Capital lease, that is an asset, okay? Just look this page over a little bit, and you'll scoop up a couple of points on the test, I'm pretty sure. Now, here we go. Here's the guts of what we're trying to learn here in chapters 9 and 10, huh? Present value. Oh, right. Present value. Today, I hand you $1,000 today, Dominic. That's the present value is 1,000. That's worth today. But what if I said to you, I'll give you $1,600 in the future if you give me $800 now? Would you do that? You would not, because this $1,000 today, assuming 10%, in 1 year is going to be worth $1,100, and this year's 5 years, $1,610. These numbers equal each other. They have the same buying power at each of these periods. So you might have an investment you're looking at that's going to pay off $1,610 in the future. In the future. And the deal is you invest $1,000 now. If I came to you today and said, I'll take that off your hands for $1,200, you'd probably sell it to me. Because you know this $1,600 in the future is only worth $1,000 today. Confusing?
No, or I mean,
Taking a future value, we're looking at all these problems on the test are going to be present value, no future value stuff. So present value, of course, we know future value. I mean, everybody knows $100 today times point by 105 is 105 times here. What we're really doing is we're subtracting out the interest to get back to the present day. So we know this investment will pay $16.10 in 5 years. It's worth $1,000 today. So if someone offered you 1,100, let's say someone offered you 1,050 here, you might take it. But in a year, if they offered you 1,050, you wouldn't take it. Okay, because the present value is higher.
and I guess my problem, and maybe that's for further on this PowerPoint, is I can never figure out on the bonds, do you use the chart that says present value annuity, future value, future? So when we get to that, if you can help me discern, because it was a hit and miss and a guess.
Okay, yeah, we'll get there pretty quick here, huh? Present value of a single amount. You have two tables. One is for just one single number. The other table is for an annuity, the stream of payments, but we'll get there in a second, okay? How much do we need to invest today at 10% if we need 1,000 in 3 years? If you have the present value tables in front of you, do you have your book there? Do you have a present value table you can follow? If not, I'm sure you know how to read the table once we understand which ones to use. So what do we have here? We need $1,000 in 3 years. And we're able to invest the money at 10%. So this is just a single number. You'd go to your first table. It should say something like present value of a single dollar, okay? And you go 10
E-O. I don't know.
There you go. And then run your finger down 3 years, 10%.
3 years, 10% should be 0.75131.
Take a look at the screen.
Oops. Sorry, you mean on the
At the PowerPoint, I mean, I'm sorry.
Oh, I'm still looking at the lease liabilities, unless you've.
What?
Yeah.
It
Yeah,
hasn't.
me too.
Right.
How could that? What are you
I'm
looking at now? Present value concepts?
No, it still says operating lease, capital lease, at least on mine.
Yeah.
Okay, what's going on here, Nicole? All right, here we go.
I don't know.
Okay, I have now, what does it say now?
Lease liabilities.
Same on mine.
Still lease?
Hmm.
Right.
Okay, let me try this.
I was just going to log off because I thought mine froze, but I wasn't the only
Stay
one.
doing, huh?
There we go.
Oh, here we go.
I have no idea what happened. Okay, so the question is, we need $1,000 in 3 years, and we know we can earn 10%.
So if I'm reading that, then it's going to be answer C, 751.31.
Yeah, yeah. They give you a formula, a mathematical formula, which you should ignore, in my opinion. That's why God invented the tables. Okay.
Right.
So that's a simple example. That's present value. So your problems are mostly going to be, not mostly, all on the test, I'm pretty sure, are going to be present value type problems. Okay. Let's see what else we got here. Here, they're just showing you, going through, we all know this, 751.31 times 110% is that, equals that, et cetera, et cetera. The trick is understanding how to get back to the present value from the 1,000, present value. Okay, that table you just looked at, Dominic and Justin, that is the table for just one single number. Okay. Right. The annuity table is the table to use when the investment is a steady stream of equal payments at the same interest rate over the life. So now go to your annuity table.
Present value annuity. Okay.
Present value annuity. We're not going to look at the present. We're never going to go to the present value of the future value, I don't think.
Because of your each year. Okay, got it.
Yeah. So how much is this annuity? This annuity is $1,000, right?
Right. 3 years, 10%. And I'm just gonna double check 0.75131. 2.44371.
No,
No, wait a second. I'm gonna oh, I went to the wrong one. 2.48685. Yes.
you
Okay.
go, see it?
My
Okay,
eyes are bad. I went to the 11%. I would have got that wrong, but yes.
easy to
there you
do,
go.
easy to do. How you doing, Dominic? Dominic
Good.
still there?
Tommy, put the video on, say hi if you want, but you don't have to.
Say hello. Say hello to everybody, Nicole. Nicole. Here we go. Okay.
Hi.
So that's a quick look at present value item, okay? Here is an interesting problem. And this you're not going to do the calculation, the whole thing, but you really have to understand this concept. And this is where students get a little screwed up, huh?
Right.
Starbucks bought some new delivery trucks. The deal is they pay nothing until the end of 2 years. Okay. So that's a simple thing to understand. Wow, we get to use this machine for 2 years. And then in 2 years, we have to pay them $200,000. Well, we can't debit equipment or trucks now for 200. We must debit it at the present value, because that 200,000 today is only worth 159,438. And if you want to look at your table again, just a little practice here, that's a single number, 12%, 2 years, right? Yeah, 2 years. The conversion is 0.79717, right? So if Starbucks called us today, as soon as we started this deal, and they say, hey, I want my 200,000 now, we would send them a check for 159,438 and everybody would be happy. So we have to record this truck at its present value. And we have to compute the interest based on what the note payable balance is at that time. So at the end of the,
it's not due, even though you don't have to pay 19,000 this year, you just pay it.
we're not gonna have to, what this process is, Dominic and Justin, we're moving this note payable balance up each year till it hits 200,000.
Got it.
As the present value changes. So we bought this truck for 159,438. We multiply it by the interest rate and we get interest for the first year of 19,133. So look at the journal entry. You debit interest expense and you credit note payable. So the note started off with a present value of 159,438, right? Now we've increased that note by adding in the first year's interest we're going to have to pay. And then we are going to say that that note was 159,438. We're going to add the 19,133 to it, which gives us, what was that, 178,571, whatever. And we're going to multiply the new note balance by that amount. And when we've done that, if you add these three numbers up, 159,438, if you have a calculator, 159,438 plus 19,133, which increased the note, which is why the interest expense is higher in the second year, it equals 200,000. 159,438 plus 19,133 plus 21429 should equal 200,000.
Yeah, it does.
Are you clear? What do you
Waiting for
think,
it.
Nicole? Are you good on this one?
I think so.
This was the one where that poor girl had the trouble last week. Oh, you weren't in that class with me. Anyway, this was the problem she was trying to understand. Okay. What do you think, Dominic? Make a little bit of sense?
Mm-hmm.
All right. Let's see what else we got here. Oh, heck. They give us the answer too fast. Okay. Now, here's where we're going. Say hello to your first bond. They're not telling you this is a bond, but this is what it really is. Starbucks buys equipment with a note payable to be paid off in 3 annual payments, huh? So, okay, so we have an annuity with 3 periods. Each payment includes principal and interest. This is just the annuity. What is the present value of the annuity? Why don't you just tell me what the conversion number is?
All right, I'm looking that up now.
So it's 11% for
Should be
3 years.
2.44371.
Congratulations.
Cool.
Okay. So I think you have a better sense now when you use which table. A single number, you got the first one, the annuity after that.
Multiples. Okay.
Yeah. Starbucks purchased equipment with the notes payable to pay off 3 equal amounts. Oh, this one's kind of fun, huh? Okay, the present value is $400,000. Okay. Now here we're going to see an example where the interest rate goes down every year. They're
Right.
paying 163,685, right?
Right.
This is the present value. 400,000, we can call it. So the first year, they're going to take, I'm sorry, let me back up real quick. The first year, they're going to take that 400,000 and multiply it by 11%. Okay. Interest expense is 44,000, right? Not too hard to figure. What is the annual payment they have to make? 163,685. The difference represents the reduction of the note. You want to dwell on that for a few seconds?
Hmm.
Present value is 400,000. So that means the annuity comes that annuity comes out the ones they're telling you the annuity 163,685. That's going to be the cash every month. So first month it's 44,000. First year 44,000. The difference is a reduction in the note. Now the note has gone down from 399 minus 163, right?
163.
No, it's too bad they don't continue with it. The next year, you would now have a note balance of 400,000 minus 163. Let's call it 237. You'd multiply 237 times 0.11, and you'd get a much lower interest rate.
You paid a
The
lot.
cash is the same, but the amount of the note being paid down would be the difference between those two, as always. Okay. That one, this type of thing might be on the test. I mean, it's unfortunate that your whole test is multiple choice and true, false, because I like to have problems when I give my test out.
That was killing on the that 10-point homework though, to actually have to, or even the exercises or whatever.
Yeah,
to
this
try
is
The
not
multiple choice.
not intuitive stuff at all.
Right.
Present value. Now here's the bond. I was wrong before when I said here is a bond. Okay. The reason I'm calling it a bond is it's an investment where you have a annuity and a single payment. That's what a bond is. I loan you $400,000 and you pay me X amount every period. And at the end, we settle up here. So Starbucks bought new roasting equipment and agreed to pay $1,000 a month, 20 months, and an additional 40,000 at the end of 20, 12% interest, huh? Shows you how old this book is. The 1,000 per month is an annuity. We have to go to the annuity table for 1% for 20 months. And I get 1% because it's 12% a year. So let's take a look at it. I'm not even sure your book has that conversion. What's the present value of the annuity? They're starting with the annuity. You go to your table. If you have 1% there over 20 months, that should be the conversion. So we have to make payments of $1,000 a month for the next 20 months. We need $18,046 in the bank today if we want to reach that number. That is the present value. We're going to be paying $20,000, right, over 20 months. When we discount it back to its present value, it comes out to 18,046. That is the present value of that part of the investment. Okay.
So it's a two-step.
Yeah, you have to use both tables on this problem.
When you're using the present value. Okay.
Yeah, we just calculated the present value of the annuity portion.
Right.
but they have to pay more than that. At the end, they have to pay a single number. So you go to your other table for 12%, I'm sorry, 1% for 20 periods. And here is that conversion. So in order to have $40,000 in 20 months at this interest rate, you have to have this much in the bank right now, if you want to look at it that way.
Interesting. So what I see in just kind of reverse engineering this present value
Yes.
of annuity, to get that 18.04555,
Yep.
you do look at 20 periods, but you do only look at the 1% because
Right.
you're dividing that down.
1% per month. Yeah.
Okay,
Yeah.
because the 12%.
Simple. You know,
divide it by 12 to
Yeah.
find that 18 number.
yeah,
Okay.
so there's your present value, 50,828. And here, we're not going to go into this. Okay. Let me call up the bonds. Everybody's anxious to see the bonds section.
Sure.
The bonds.
James Bond.
Nicole has Sean Connery died last week, huh?
Big fan.
Oh, yeah. People make me laugh when they say he wasn't the best James Bond. What is wrong with these people? Remember Goldfinger, the all-time classic, right?
Sure. That really was best. I think it was the second one.
Blofeld, the evil Blofeld has James Bond on the saw. You know, he's got him tied on the board, and the saw is coming toward his head. And he says to Blofeld, "Do you expect me to talk?" He says, "No, Mr. Bond, I expect you to die." You know where I'm going with that.
Right. Awesome.
He was what a bunch of nasty crooks those guys were. Okay, here we go. Bonds. Well, we just learned bonds when we looked at that last problem. Okay, so let's take a little bit more time here. Companies can raise money by borrowing or issuing stock or putting their own cash into a business, huh? This chapter is all about borrowing money in the form of a bond. And bonds have advantages and disadvantages. One advantage of a bond is if you borrow money, you retain 100% control of your company, because a bond is just borrowing money. Whereas if you issue stock to the public, you're giving away part of your company. That's the very definition of issuing stock. Advantage of a bond: company doesn't lose any value in terms of its net worth, and the interest expense is tax deductible. And this one makes me laugh. The impact on earnings can be positive if you borrow the money at a low rate and then invest it at a higher rate. Who knew that, huh? Anyhow, I don't mean to belittle that question, but yeah, if you can borrow money today for, wow, the rates are so low today, you know. But if someone's willing to pay you 3% today, you would grab that in no time. The problem with a bond is you have to pay it back. It's a legal document. It has priority over accounts payable in the event of a bankruptcy. If a company has $1 million left in debt and the bondholders have 900,000 coming to them, they get that 900,000 before the other guys. And there's a negative interest because the principal and interest must be paid. Well, we know that, okay? Bonds, these are terms we need to understand, and we will as you do some of these problems here. The principal is the amount you borrow. It's the amount you borrow. It's called the face value. Face value, I think, is the normal term I hear most of the time. The principal, you borrowed $1 million. The coupon rate is the rate that you're going to pay the bondholder. That's the rate that appears on the bond. You bought my $1,000 bond, and I'm paying you, say, 8% a year. You're going to get a check from me for $80 every year until this bond matures. The coupon rate. You never go to the present value tables with the coupon rate. Never. Where you do go is what's called the market rate. Let me just bring this up here where I can. Yeah. I don't know about you, but I'm more comfortable now. The market rate In this chapter, guys, we're going to always be considering what the market rate is compared to the coupon rate. The coupon rate is what we're paying to borrow money. The market rate is what
Like a
similar companies are offering in terms of interest. And what we're going to learn here is if we're paying more than the market rate, people are going to come to us, obviously, and we're going to get what's called a premium, and the other way around. Let's take a peek. Here are some nice, easy terms to remember. Again, I don't have an opportunity to see the test because it's unavailable to me. Cornelia is really the main teacher here. Bond payable, a debenture, an unsecured bond. We know what an unsecured bond is, right, Nicole? You come to me to borrow money, and I look at Nicole and I say, oh, yeah, she's good. I loan her the money with no collateral. Secured bonds, collateral. You know, I go to Nicole to borrow money, and as soon as Nicole sees me, she says, I want the keys to your Lexus before I loan you anything, okay? Callable bonds. Callable bonds are interesting. A callable bond is one where the borrower can terminate the bond. In other words, Dominic and Justin, everybody, you borrowed money 10 years ago from me. You bought my 30-year bond when the interest rates were 10%. And for all these 9-10 years, you've been paying me 10%. If it's a callable bond, you can escape from that horror. You can simply contact me and say, Bob, here's your $100,000 back. Here is the accrued interest in cash up to this point. Plus, there'll probably be a little bit of a penalty. So if it's a callable bond and the interest rates go down, you may call the bond and then just issue another bond at the market rate, the lower rate. Callable. Convertible bonds, I don't hear about these at all anymore. It just means this: you buy $1 million bond from IBM, and the bond's 20 years, and then after a few years, you say, geez, I'd rather have their stock. You just contact IBM and they'll sell the bond and buy a commensurate amount of stock. It's convertible from a debt to a stock. Okay. See what we got here.
Can you just quickly, why, market value of the bonds, I guess, going back, why do we concern? Is that because it's resold? Like people are like, oh, well, here's a guaranteed 8%, but I'll sell it to you, because here it's more guaranteed. I mean,
that's a part of it. Yeah. Yeah. Bond is like a stock. It can be sold every day. What we're going to do in a few minutes here is what we're going to learn is that if you're offering a higher rate than the market rate,
right,
the lender is not going to give you 100,000. He's going to give you 103,000 to get the market rate.
Got it. Okay.
And if it's the other way, it'll be sold at a discount.
Right.
Okay.
So when they're selling these bonds out on the market, let's say out on a bond exchange or something,
yeah,
we get that higher amount, even though the stated rate is.
Yeah.
Okay.
Yeah.
Right.
Exactly right. Now, I've told this to everybody before. There's one word that our course does not use, and that's risk.
Right.
This chapter assumes that all bonds are of equal risk, or no risk. They don't think about it. Okay.
But each of those 4 bond categories are going to have different levels.
Yeah.
The bond.
And the bond issuer prepares a prospectus with rule covenants, trust. I hope they don't have this on the test. Prospectus, we know what that's the booklet they put out. If IBM wants to borrow $1 billion from the public, they have to tell the public what they're borrowing it for. We're going to build a big factory in Tibet or something, and we're going to pay this amount, and we're going to pay it back in this number of years. So it describes what the bond's all about, so the public can make an informed decision. And then there's rules involved, covenants, and the rules I'm not going to go into. I'm not an expert on them by any means, but basically these guys have to be honest and be prepared to pay it back. And then you just mentioned the bond exchange. Yeah, that would be the trustee, I guess, the middleman. Okay. So I don't think we need to really look at that. Well, if you go to Santa Barbara Bank and Trust today with say $1,000 and you buy a 1-year CD, I understand you won't even get 1% now. Isn't that amazing? Let's say you only get 1%, which is terrible for an old goat like me. because in my dotage here, I wanted to earn some interest. I can't do that now. But I can hook you up, Nicole, and get you into a bond that pays 15%. Would you do that? Sounds good, right?
Mhm.
Sounds good. Would you do that though, Justin?
I wouldn't. I'm too risk adverse.
Exactly.
It's go broke.
You'd have to be like suicidal. Yeah.
Right.
Yeah. You buy that D bond, and yeah, and you might get 15%, and it may work out. It's possible. But if a company has to pay that much money to borrow money, there's a reason for it. There's a reason for
But
it.
do the higher risk bonds pay more? Like, why would you get a high risk bond? Is it high risk, high reward, or?
Yeah, high risk, high reward. But you borrow from IBM. You know what IBM does. You know they're going to pay you back. There's no risk. You borrow from my company, which is trying to build a time machine to go back into the past. Which company is more likely to succeed, you know? So no one's going to loan me money unless I pay a ton of interest. And that's where those interest rates come in. So right now, you know, you say you're risk averse. Yeah, if you're risk averse right now, you got to shop around a little bit. Here's a little bit of a good example, I think. Bond information. Here we go. Apple, Amazon, Walmart. Apple is paying 3.45%. You buy an Apple bond now, you're going to get almost 3.5%. The market rate, the yield, is below that. So if you buy an Apple bond, you'd be willing to pay 101.29. That $1.29 is called a premium. Let's take a look at Walmart, or go to Amazon. Their coupon rate is only 2.5%. No one is going to borrow money no one's going to loan money to Amazon for 2.5% when the market is paying 3.2. So this lender will say to Amazon, yeah, I'll give you $1,000. Here it is, 94, you know, $100. I'll give it to you, 94.92. And that's called a discount. And Walmart here, they have a little less coupon rate here, 3.30, but it's still above the yield. In fact, it's a little bit higher than the yield. It's 17 points above the yield. This one was only, so this one's a little bit higher in value. Okay. The purpose of this little slide here is to demonstrate that if the coupon rate, meaning what we're paying, is higher than the market, we're going to get more than $100. Okay. That is the whole crux of the bond world here. The bonds. Here's a bond. It has a face value. That's the a principal, the amount we borrow. The interest is going to pay 10% a year, twice a year. We need to know that. We bought this bond on 1/1/16 and must pay back the entire $1,000 in 10 years. During those periods, we have to pay $100. What's 10% of 1,000? $100 a year interest twice a year. Split it up. So the bond has the maturity date, the date it expires, face value, interest. These are all important dates. Okay. These 5 people here you see on the bond: the face value, you know how much you're borrowing, when you pay it back, what the interest rate is, the dates, and the date of the bond. What you don't see are these 2 numbers, these 2 items here: the market rate and the issue date. When did this bond actually sell? Well, here we go. A bond, the issue price of a bond, the issue price, that means how much cash we received for our $100,000 bond, whatever the number is. So in a bond, the total net book value of the bond is going to be the present value of the principal plus the present value of the annuity. You have 2 components. Add them together, and that's what the net book value of the bond is. At the beginning, the net book value is the issue. So like we said, if the stated rate equals the market rate, well, that makes our life easy. We don't have to do anything. All we have to do is debit cash and credit bonds payable and sit back for 20 years or whatever it is. But if our market rate is below, if our stated rate rather, coupon rate, the amount we're paying is less than what the market is paying, no one is going to give us $100 for it. They're going to give us 95 or something. Stated rate is high, we're going to get more. Okay, so those are the relationships there. And again, the word risk does not come into play, which would kind of blow this out of the water a little bit. Bond issued at par. Wow, that's nice. 10% is the market rate and the coupon rate. We're done. We don't have to do anything now for 10 more years.
I wish
Okay.
those were the only questions on the exam, man.
Yeah. That's a good sneaky question there. Yeah. I'll show you all kinds of sneaky questions in the next minutes here. Some of these problems we're going to see where the market rate is 10% and the coupon rate is say 8%. That's a 20% difference, right? That's really a 25% difference comparing the 8 to the 10. That will probably never happen in the real world. If there was such a real difference in the market like that, the market would blow up. Who really looks at these interest rates like crazy? You ever hear of these flash traders? You ever hear that? These speed traders, these investment houses that have this powerful computer equipment where they're monitoring everything that's going on. And as soon as they see like a 0.1% tick up in an interest rate, wham, in a nanosecond, they've capitalized on that by buying or selling. It's kind of amazing. Michael Lewis's book. That's my point is, in the real world, these are real small ticks. So here it is. We borrowed the money. We debited cash, credit to payable. And now we have to record the interest every 6 months. It was 10% divided by 2. So we're going to make this entry 4 times over the life of this thing, or however long it was. And here we go. I guess it's 10 years later. Wow, look at this at the end of 25. Debit bonds pay. So if it's issued at par value, there's really nothing to do for the most part. Now here we go. The famous BNSF company, the Burlington Northern Santa Fe Railroad, issues $100,000 bonds with a stated rate of 10. The market is 12 though. So they are not going to get 100,000. They're going to get a lower number than that because no one is going to borrow money, is loan us money at 10% when they can get 12. So now we get involved in a discount. And let me just go back one moment here real quick. Okay, I want to lay this out. Okay, bonds issued at a discount. Any bond has the same calculation. You have to get the present value of the principal and compute the present value of the interest, which is the annuity. The annuity. So our bonds pay 10, but the market was 12. You go to the market, when you go to your table, you will use the market rate. You never use the coupon rate. You know what would happen if you used the coupon rate? You'd come right back to $100,000. So you go to you're doing the principal first, I guess. The single amount was $100,000, right? The principal was 100,000. You go 100,000, 12%. I think it was. Yeah, 12. They're telling us 12%. And you should see the factor, it's 0.3118. Did you find that, Justin? 12%, 20 periods. .3118. 20 periods. You see that, Nicole, Dominic?
Right. So we're looking at the actual 6% on the.
Yeah. Yeah, I'm sorry. Yeah.
Right.
Yeah.
But number of times is 20.
Yeah.
And
My-
that's where I've messed that up before because I'm.
Yeah.
looking
Okay.
at
So you found that
Excel.
then, huh?
Yeah.
Okay. So we multiply that out, and that $100,000 today is worth what the heck? Oh, for heaven's sake. Oh, here it is. I'm so sorry, guys. I'm racing along. There you go. That 100,000 today is worth that number. Okay. And I keep saying another way to say it, guys, is if we want $100,000 in the bank in 10 years under these rates, we have to have this much in the bank now. So that 31,180 equals 100,000. And every number in that present value table equals what amount, Nicole? I'm busting Nicole a little bit. Did we talk about every number in the present value tables equals what number? What dollar amount? Give up? $1.
Okay.
Everything in that, every number in that, those tables represent $1, okay? So now we know the principal part of the bond. Let's look at the annuity. The annuity was 10 years times 2, 26%. Go to your annuity table. And you should find 11.4699.
6%. Right.
Okay, so we have now figured out that the principal of the present value was 31 of the single number was 31 something. The annuity's 57. Guess what we're going to do with them? We add them together. So this bond will bring in $88,530 in cash. Yeah, the thing we have to remember with a bond is that it's a two-pronged vehicle.
Right.
Single amount, annuity.
That
Add
part
them together.
It was that when there's two of them going to the 6% on the chart, not the 12. I kept going.
Yeah.
to 12%.
Yeah, I don't know why they slipped that half year in us that quickly, because that
Right.
tends to confuse
That was definitely-
people, including me once in a while when I go too fast. So that 88,500 is called the present value of the bond. It's also called the issue amount. It's the cash, and it represents the net book value at the beginning. So here's our journal entry. We know we're going to record it at a discount. So we know we're going to debit cash, 88,530, right? That's what we just computed.
Okay.
How much do we have to pay back though in 10 years? 88,530? No,
100,000.
we have to pay the whole 100,000 back. So this lender is going to collect 10% interest for the life of this bond. And then when the bond matures in 10 years, we're going to send them a check for the full 100,000. You see this bonds payable number? When you're talking with bonds, this number is not going to change. That's going to stay at 100,000. Okay. You remember when we had, I'll show it here. This might make it a little more clear. Remember when we bought a piece of equipment, we could depreciate it? We bought equipment for $100,000 and the accumulated depreciation was 40. And we called the difference the net book value. That's what we have here. Same thing. So you have a bond payable of 100,000. That's not going to change. $100,000 less that 88,530 is where we got that number we plugged into the journal entry. Okay. Going forward, what we must do now is amortize this 11,470, this discount, over the life of the bond. And when we say amortizing, in this case, we mean reducing this contra liability account and moving it gradually into interest expense. If this was a callable bond, this would be the present value at the beginning, okay? We're gonna learn two methods here. One is a good method, and the one you should use, and one is this method, straight line, okay? Straight line, I'm not even sure if it's GAAP. It seems to, now I never got involved with bond discounts and stuff where I worked in the factory, but I do know the auditors would come in and they would look at this type of thing. And if they saw we had straight line bond work being done, they would redo it under the correct method. And as long as you were close, not material, you're okay. So straight line, we got to know the amount of the discount. We're going to divide it by the periods until we get the discount to zero. So let me demonstrate with a good looking chart in a moment. Okay, here we go. The discount was 11,470, right? 470. How many payments are we making? 20. 11,470 divided by 20 means we are going to amortize this amount every 6 months. Straight line. So our first year, the interest expense was 574, the discount rather. We agree? That's what we computed here. We are going to reduce that discount with a credit every 6 months. So here's our journal entry. We're going to credit cash because that's how much we have to pay. That's the coupon rate, 10%. We are amortizing 574 of the discount. We're moving that 574, and now we can call it what it really is, interest expense. So look at your total interest expense. It's not just the 5,000. It's the 5,000 plus the amortization. So if a bond sold at a discount, your interest expense is going to be higher. This has two components, the cash component. And remember, we never got 100,000 in the first place. That discount is in a way delayed interest expense. So after 1 year, our net book value has gone down by 574. This number was 11,470 when we began, right? And now it's gone down. As the discount is amortized, the carrying amount of the bonds decreases. Now that's the type of question they love to ask. They'll say something like, the issue price of a bond increases with each period. And then they'll say, was that bond sold at a discount or a premium? Well, we need to know that if it was sold at a discount, we have to increase it to get to $100,000. Now, this is a real good table here. This is the one that I think really will help clear it up, I hope, a little bit. Here's our starting point, the book value. Book value, 88,530, 11,470. That represents our 100,000. Every period under straight line, we're going to amortize 574, 574, 574. The total interest paid is 5,000. We know that. So to get this number, we just add them together. That's your interest expense. Now, let me call your attention to the book value and the unamortized. What was the book value at the beginning? 88,530, right? 88,530 at the beginning. How much did we amortize? 574. 88,530 minus plus 574 plus 574 plus all the way. You do this for 20 years, you'll come up to 100,000. that means that at the end of 20 years, 20 or 10 years, 20 periods, the book value of this bond will be 100,000 and it equals the amount you have to pay. The unamortized is going the other way. We're reducing it every month. Every month. And at the end, we will have 0 on our general ledger for discount and 100,000 to pay. What do you think, Justin? You drinking that in now?
Yeah, no. It's making a lot more sense visually with seeing this as opposed to reading the book and doing the homework.
Oh yeah, yes. I mean, and students get scared at the bonds. And I remember when I was in school, I had all kinds of trouble with this particular stuff. But yeah, that's what we're talking about. We're going to take that net book value and we're going to increase it or decrease it to get to the bond principal amount. Okay, so that's one method. That's the lesser of the methods. The problem with this method is it doesn't exactly match up the revenues and expenses properly because the present values are not quite lined up. Now, here's the one that is the way you really should do it, called the effective interest method.
And these are just options that a company has to record it on the books, right?
Yeah.
There's 2 different accounting methods. That
Now, I might be wrong. And if another teacher hears me say this, I'm not sure straight line is GAAP. But if you're using straight line, the auditors will check you out. And as long as you're not out of what they call materiality. In other words, if effective interest came up with $1 million and the other one came up with 990,000, the auditors will say that's close enough type thing. Effective interest method. Although with computer power today, I don't know why anybody would use a straight line. Okay, compute the interest expense. Now here's the key difference. Before, under the straight line, we calculated the amortization first. Here, this method, we're going to calculate the total interest first. Your total interest expense is this, very important. The net book value times the market rate is your total expense. Net book value time, what's happening here? Let me get rid of this. Net book value times market rate equals total expense. That's just a rule you have to understand. So with that in mind, we have a bond. The issue price was, we're doing the same thing, another discount. Here, we're going to use the effective interest method, okay? So what do we just say? The net book value times the market rate, which was 12%, right? Equals 5312. That's not so tough. Right, Nicole, as long as we remember the rule.
Yeah, this is what we did the other day, right?
Yeah, we worked hard on this the other day, remember? Yeah, net book value at any point in time times the market rate gives you the total interest, which in this case is 5,312, not the 5,540 we had before. So let's take a look at our journal entry. Well, we know we have to pay the cash. That's a constant. That's a given. And we know that the total expense is 5312. Whammo, we plugged the 312. And that's going to reduce the bond. Here is your presentation on the balance sheet. 100,000 minus the discount gives you the net book value after the first payment period. As the discount is amortized, the carrying amount of the bonds goes down. I'm trying to point. Okay, here we go. Somehow this bug keeps, okay. So let's continue. Here you go. Here's our famous chart again. You remember this, Dominic?
Yeah.
Yeah. Not too tough so far, huh? Okay, I hope, right? Here we go. Net book value, 88,530. Net book value. What's 88,530 times 0.12. Who's got a calculator? Dominic, Nicole, Justin?
Let me see.
10623.6.
Yeah, this is where you left off, Justin, right? You were looking at this presentation?
Right, right.
Here we go. Here's our friendly table.
Hmm.
What did we say is the calculation for total interest expense? Book value times market rate. 88,530 times 0.12 divided by 2, because it's twice a year. Did you get 5312, Nicole, when you did that?
Yeah.
Yeah.
Thank God, huh? I don't know how many times I said that's what you got, and the student says, "No, I didn't get that." Okay, 5312. How much is the coupon amount? 5,000. So our total interest is 5312. Here's our amortization. So after the first 6 months, 88 plus 312 gets us up to 88,842, 1174 minus that. You want to do the second year, Justin?
I'll give it a shot. Okay, you mean, oh, on the chart,
Yeah, the calculation.
right,
See if you can figure out what the numbers. Well, the numbers are there, but they'll let you calculate them.
right. And as we're,
What's our formula for total interest under this method?
this is the, sorry, the present value.
Exactly.
And
It
And
is
then,
the
right, okay, so present value. And it's half, and it's at 12%, so it's gonna be 6%.
Yeah.
And then 3. All right, let me see if I can. 12%, 6% times, and it's 3 years. Is that? Is it?
No, this is this is
Sorry.
what 4 periods, right?
4 periods, okay. Is it 0.74726?
No, you're making it much too hard. You're making it
No.
much too hard. You don't need to go to the table.
Oh,
88,842 is where we are now. Multiply that by 12% and divide by 2.
got it. Okay, there we go. All right.
Did you come up with 5331?
I'll say I did, but let me.
That's what my father used to say.
There we
Let's not say we did. Okay.
Right.
You got
right.
the 5331? You
Yeah.
get the idea?
Yes.
You want to try the next one, Dominic?
Sure.
$89,172 times 0.12. So maybe when you're studying, have this in front of you like crazy, you know?
Right.
Yeah. And then you sub, or in the, so that's 10,700.64.
What's that?
10,700.64.
What is that? Oh, you know, I'm not sure
Well,
where you are.
Well, you got to divide by 2, Dom.
Oh,
Yeah,
okay. Yeah,
so-
divide by 2. Yeah, I'm sorry.
Yeah, so 5350.32.
Okay.
Yeah, so there it is there. Yeah.
Okay. So we just covered a discount. If you know how to do a discount, you know how to do the premium, but let's look at it. I don't think there'll be anything on zero coupon bonds other than maybe a question, true, false. Zero coupon bonds don't pay interest, cash
Right.
interest, true.
Like on the quiz or the homework or something. Yeah.
Yeah, zero coupon bonds, they'll probably pay a higher interest because there's no cash till the end. In other words, you're giving somebody $80,000 today, and then in 2 years they'll pay you 20. Okay, now the Burlington Northern Santa Fe Railroad issues bonds that have a rate of 10%. But look at the market rate. The market rate is 8%. Whoopee! We're going to get more than 100,000. So here's the calculation. Now we're working with 8% market rate when we go to the table. So using 8% for, what is it, 20 periods, 4%, we come up with 0.4564, huh? In your present value table. Okay, so take a peek. The present value of that 100,000 That 100,000 we're paying in 10 years equal the buying power of 45,640 today. Okay. Now that we did the principal, we must do the same thing with the annuity. You go to your table, 20 periods, 4%. Multiply it out, and you get 67,952. I need a little whiskey here. You know Jackie Gleason, right, Nicole? You don't know Jackie Gleason?
Mm-mm.
Oh, Jesus.
I don't think so. I'm really bad at names, but faces I can remember, but names.
The funniest guy that ever lived. He was famous for picking up a cup of coffee and pretending it was booze. Yeah.
What did you say his name was?
Huh?
What did you say his name was?
Jackie Gleason, Gleason.
Let's see.
Google the honeymooners, Jackie Gleason, the honeymooners. You'll laugh for the rest of your life. Okay, we're good with that calculation, guys?
Right. And again, this was tough. Whether I go present value annuity, present value, and then I have that difficulty of forgetting to split the 8% into two. But
yeah,
again,
and that might be on the test. That little problem.
Right, I could see that.
So here we go. Look at this. We're going to get a total of 113,592. Keeping in mind, this is a ridiculous scenario. This could only happen in like Venezuela, or where interest rates are all over the place. Okay, so we're going to debit cash for 113,592. How much do we have to pay back? 100. Here's your journal entry. This time it's a liability called a premium. And if you think about it, that's really interest income we can't recognize until the bond starts maturing. So we're going to amortize over 10 years, and we'll go through the two methods again. It's the same exact thing. This is a 20-period bond. So on the straight line, we take that first premium amount, we divide it by 20. That's going to be the discount every 6 months. The discount every 6 months, or the amortization, I should say. So take a peek. Cash, we have to pay the cash, 5,000. But this time, because this was a credit, now it's on the debit side, we're reducing it. So look at our interest expense. It's lower than the $5,000. It's lower because now we're recognizing some of that premium as really interest income this month, if you want to think of it that way. You look a little confused, Justin?
No, I'm getting it. I'm getting it. So
okay. You got, Dominic, Nicole, interrupt if so take a look. Here we go. Once again, 113,592. So if a question was true or false, the net book value of a bond sold at a premium decreases each year. True. It's so easy to get confused on the test when you're under a little bit of stress.
Right. Time. Right.
Yeah. Okay, where were we? Okay, we just gone through this, right? Oh, where am I going? I'm getting way ahead here. So sorry, guys. Okay, here's where we were. Okay. Effective interest method, which I don't think is any harder than straight line. Okay. What's our issue price? 113,592. And we go here, we're going to come up with the same numbers, I would imagine, huh? I just don't like the way this thing is jumping around on me here. Effective interest. So effective interest, remember what our formula is. Effective interest, we're calculating the total interest. Effective interest method, you're calculating the interest. Straight line, you're calculating the amortization. Since we know what the cash payment is, the interest expense in terms of money, It's easy to figure the part 3. So here we go. We go through our calculation. And now they're skipping ahead. They're not showing us the grid, I guess. I don't see the grid yet. But what is the interest? What is the amortization for the first 6 months? How would you do that? What is the beginning book value? 113,592 times 0.08. That is your total interest. Total interest. Confuse you there a little bit, Nicole? I kind of slopped
little
around. Yeah, I was expecting them to mimic everything that we did with the discount before. Here, the bonds at a premium, we're using the effective interest method.
Okay.
Net book value at any point in time times the market rate. In this case, we have to divide it by 2, equals the total interest, which oddly enough is less than the interest we're paying. And that's because this premium we received at the start of this note is really like delayed interest income, if you will. We couldn't call it all interest income at that time because the present value would not be correct. So if the bondholder, if the guy wanted to pay us back now, he would have to pay us back at the present value. Oh, good. Here's our chart. I thought I missed this. Same thing. I don't think we need to go through the arithmetic, huh, Justin? You've seen one, you've seen them all, right?
Right.
So the
And
key
I'll
thing,
go back and play with it too. To really
yeah,
watch.
on the test, you'll get questions that say, what is the total interest? And it's very easy to say, oh, the bond pays 5,000 a period. That's the answer. Now, the total interest, you might have to consider the amortization. So if they gave you a problem and they said that the book value is 113,592, what's the total interest? One of the answers in the multiple choice, I'm sure, is going to be 5,000. It'll have 4544. It probably will have the answer if you're doing it straight line. You know what I mean? You just have to kind of be alert for that. We must be alert.
But here the total interest is going to be the 13,592. Oops, sorry on that.
The total, no, the 13,592 is the amortization. It will be turned into interest expense. Yes, that's the whole point.
Okay, but the answer to that question, at least on this, would be if we said what was the total interest and we had that question, the answer would be 4544. Okay.
Exactly. Good. Exactly. Okay. Exactly. Yeah, a lot of the multiple choice questions will be thinking about having this grid in front of you and popping in a number or two. I'm not going to look at that. Okay. We've just gone through bonds in a pretty good detail. Early retirement of a bond. Okay, this is not much on the test, but we need to know it. And you know, who knows? This might be the point that gets you from an A+ to a super grade, right? Early retirement of debt. If it's a callable bond, remember callable bonds? If it's a callable bond, the issuing company can call the borrower, or you know, can call up the lender and say they're paying them back. So what we have to do is as follows. There's nothing that follows. So I'll tell you what we have to do. We retire a bond in midstream, say, okay? The present value of the bond, say it was 113,000. If we were to call this bond, say at the end of the first year, we would cut a check to them for 112,661, which represents the principal and the accumulated interest up to that point, the accumulated amortization. We would send them a check for that amount. But there might be a penalty on top of that. So the penalty might be 1%. So we'd have to send them a check for 112,661 plus another $1,100. The retirement of a check. And you can have a gain or a loss depending on when it was retired. again, this is not a big thing on the test by any means, but it's not a real tough concept. And if you have it in your head, bonds are retired. Why would you retire a bond, Nicole? What would drive you to retire a bond?
No, I don't know.
You don't know. You don't know.
I don't know.
Justin's just dying to answer this question.
I think maybe even Nicole came after we talked about it, but
Yeah,
yeah.
I
So
had to
say
disappear for a
Apple
little bit. Sorry.
if Apple issued a bond at say 12%, but now the interest is 3%, they would want to terminate the bond and then reissue the bond at 3% so they can pay a lot less interest. I don't know if I explained
Oh,
right.
yeah.
Yeah.
If there's a wide variable and it's not that much
Yep.
of a penalty for
Yeah,
them.
exactly. Yeah.
Yeah.
If you were stupid enough to loan me money at 10% a year 10 years ago, and the interest rates are now 1%, you're stuck unless the bond is callable. And that's what you would do. You'd say, hey, Bob, it's nice doing business with you. Here's your 100,000. Here's your interest. And here's the kicker, whatever the penalty might be, another 1,000 or something.
Right.
So, and that's kind of how they might word the question. They might say, under, if they might have a true false question that says interest rates have risen, would you be inclined to retire the bond? The answer, would be no. You're not gonna retire a 5% bond so they can now borrow money at a higher rate. So, all right. So that was a pretty good tour, I think, of chapters 9 and 10.
Yeah.
A little test prep. Any questions, guys? Anything you want me to look at again?
No, that was good. I appreciate that.
Okay. All right. Well, when's your test? Today or Sunday or something?
I think it opens tomorrow through Sunday.
And what is
better at that than I do? I don't never.
And what does Cordelia do? Open up the test for you can
It's
get in
open
there.
now. Yeah, it's
Right.
due the 15th, but it's open now.
So but when you go in there, it's a one-time thing. You can't go in and out.
Yeah.
Right.
Okay, so you can delay that fateful moment as long as you can, huh?
Right. Start at 10 o'clock on Sunday. No.
All right, sounds good. And let me just do something real quick for Nicole. All right, I guess we can cut this off then, huh?
Right. And just look at that FSA homework that was.
Oh, yes. Do you want me to go over that here?
Yeah, because I just couldn't even.
Come on, it's a piece of cake. I'll show you real quick.
Right. I figured I was just missing something. Let me get off the couch and grab that piece of paper.
Yeah. Let me find an Excel file here. Bushiba. Okay. Here is your front page. Should look something like this, okay? Now you got the annual reports I sent yesterday, right?
I maybe what my problem was. Maybe I missed seeing the annual reports. That might have been something you sent after the email, but
Okay.
I didn't get them either. I just Googled.
Did I send one to you, Dominic, yesterday?
I don't think so. I didn't know where to get the numbers from.
Oh, okay. I thought I sent it to Dominic.
I
No,
meant-
I don't plan to send it to the rest of the class. That really you're supposed to do it. But I'll show you here to get you
Okay.
going, okay?
Yeah, if we can Google it and find it. I just missed on. Okay.
Yeah. Let's take a look here. This is what we're looking for. Net sales minus cost of goods sold, as we should know, equals gross profit, minus operating expenses equals net operating profit. So I'll show you in a minute off the annual report, the best place to look for that, okay? So we're going to get those numbers for 19, should be 2019, 2018, and 2017, because Kellogg's is on a completely different fiscal year. So we get these numbers now, okay? We got these from the annual report. The net sales represents 100%, right? Net sales 100%. Component percentages are simply these numbers as a percentage of the sales. Divide 36354 by 91578. 36354 divided by 91578 should come out to 39.7%, right? Anybody able to verify that for me?
I just have a quick question.
Sure.
Okay. On Canvas, Cornelia put a example paper.
Yeah.
But it's set up differently than this.
Oh, I'm going to be in trouble. I think I might have given her the wrong one, or one that's not complete. Yeah. Okay. The one, in fact, I will send this out to the whole class now that you mentioned that. Okay.
Because it looks.
It just omitted the columns in between here. I think what was wrong with the one that you got? It didn't have this percent column here or here. I think that was the difference.
No, it has percent. So it goes 2019, 2018, 2017, and then.
You want to show it to us?
Yeah, please. Because I already did it. So if I have to redo it.
Well, that
then,
depends.
Okay. Can I share?
Yeah, you might have to redo it. Hold on.
Oh, please.
Okay, you are now a co-host.
Okay.
And let me lower this down.
Okay, so this is how.
Yeah, I see exactly my problem. Yeah.
And then I set it up
Okay.
like this. And this is mine, but this.
Okay. Okay, now hold on here. So you got this, okay. And then you got the change from here to here and the percentage change. So this looks perfect. This looks perfect.
Okay.
Now, this one you thought was different somehow? 19. Yeah, see, you see where we screwed up on this one? We don't have the percentage columns in here and here.
Yeah.
So I will not quickly, before the end of this afternoon, I'll get a clear email out with a mea culpa. But yeah, this is the right template right here. Okay. All right. Can I have the screen back, please?
Sure. There you go.
Thank you. Okay, we can see the spreadsheet again.
Mhm.
Okay. Total 100%. Everything below that is a percentage of 100%. 36354. For those of you who fool around with Excel, 36354 divided by 91578 is 39.7%. 55224 divided by 91578 would be 60.3. Another way to talk about it is 91578 minus 36554 equals 55224. So must 100% minus 39.7 equals 60.3.
So we'll get the numbers off of this chart that would be similar, 91578, 36,354. And then part of our assignment is to do that mathematical.
Right. Right.
Okay.
At that point, you'll have the differences between the 2 years here, the 3 years.
Okay.
You're comparing 19 and 18 and 18 and 17. So one of the things that we like you to do is compare the two companies first. And maybe one company might have a much higher cost of goods sold, but the other company is more profitable because they have much lower operating expenses. You want to look for those differences. But
Okay.
where I really would like you to go, though, is give us reasons for some of these differences. And the way to get that is reading the notes to the financial statements. I don't mean reading that whole 140-page 10K, but zero in on cost of goods sold. Companies on the 10K, companies have to give you a lot of information for that. Well, cost of goods sold, we managed to make a good deal with a vendor. He cut our prices down for wheat. Okay, these are cereal companies. The guy
Yeah.
who's, the guy who sells us sugar, we got a good break on him with a long. So there'll be reasons for some of these things. What's the, why is, their sales were 91, let's see, their cost of goods sold was a percentage of this percentage, compare them, get some reason for differences. You might see that one company had the bad luck to get hit by a hurricane where where their cornfield is, you know what I mean? So component percentages are all about what they're doing with their sales. They get $1 in sales. They end up with 36 cents at the end of the period. That's pretty darn good. How are they getting there? The component percentages, that's what we just talked about. The time series, now we're not comparing components vertically, if you will, say it that way. Now we're comparing the components from year to year. So very simply, we start with the first year, 91578 minus 79871. I think I stepped on this number yesterday, so that number's not. Oh, that's right. Yeah, I'm sorry. Yeah, first year 91578, second year 79871. Difference.
And those are just pulled right off of the 10K form that we'll be looking
Yeah, and
at.
I'll show you that in a moment here.
Okay.
Yeah. So now we know what the difference is in dollars. Their sales in this fictitious company rose $11,700. As a percentage, how high did it go? It went up 14%. And I'll show you a simple formula. I mean, this is just me being a little bit of Sheldon Cooper. But the way I like to do this is, let me start again. The simple formula is plus 91578 divided by 79871 close minus 1. And there's your number. I mean, you don't have to do it my way. I mean, that's just the simple Sheldon Cooper thing. You could, the other way to do it is take 14% of this number and then subtract. But I like my little form there. Okay. So here we're seeing that their sales went up 14%, and the prior year it only went up 3%. Huh? So we might compare it to these people and have some comments. Kellogg's sales fell over the last 2 years due to a change in the market. Not many Gen Xers are eating cereal like we used to eat when I was a kid. Now they run out to McDonald's, you know what I mean? Or they grab an energy bar. So they'll talk about what they're going to do about those sales. You're going to find that these companies are heavily involved in more than cereal. So give me just 1 second here.
Now, yeah, I just didn't even know how to start. I was confused. So now, yeah, this makes a lot more sense.
Yeah, this is
boom, pulled net sales, pulled cost of goods, pulled gross profit operating across the board, and then just punch that in, start running the number.
Yeah. Just give us about 4 pages, I think Cornelia wants. Here we go. Kellogg's annual report. Just Google Kellogg's annual report, like you said. There it is.
Right.
I did this yesterday.
easier.
Oh, here it is. Oh,
They should have pulled it right off the SEC or their own companies. That way we don't get, if we go to Yahoo or something like that, we might get a little bit.
yeah. I mean, just the annual report. Now, here it is, and let me share it. Share and share alike. We see the annual report there?
Mhm.
Perfect.
I'm going to go real quick. I think it's like on page 20. On Kellogg's, it comes up on page 20 something.
I think it's 24, if I'm not mistaken.
Hey, who's the professor here? 24. Okay.
I'm just trying to help you.
Awesome. Thanks, Nicole.
That joke, I used that joke once a semester. It works better in the classroom. When somebody
25,
catches.
sorry.
You
You
know,
gave me the page actually last time, so technically
So
While
what
you're
you
on
think?
I got it from you in the beginning.
Can we
Uh-oh,
enter your video, your recorded lectures somehow? Because a lot of times I'm working at 10 a.m., but today's Veterans Day, so I'm not in court. Like, do you guys post the lectures that we missed live, or
yeah, every one of these is in Canvas.
God,
Also,
missing
if
it?
if you go into the Bob Smagula YouTube channel, they're all up there too, labeled.
Okay, I need to do that. Okay.
Yeah.
That's,
Okay.
because that's where I've really been missing out.
Yeah. So let's see what we got here. Here is the information you need for the first part of this thing. Net sales. There you go. Now, this is not their financial statement. This is just a little list of different information, but it's right here. Here are the net sales.
Boom.
What was the gross profit? Well, they're giving it to you as a percentage. So just multiply it out.
On page 54, it has the.
There we go. Yeah, let's go on page 54 here. Thank you. Come on. Page 54. Oh, for heaven's sake. The only way I seem to be able to do it. 34, 40. Hey, Justin, you know who Jackie Gleason was, right?
Yes. Because I'm
You ever see The Honeymooners?
Yes. Yeah. Well, I mean, still old episodes of it, but yes, I've seen it. Right. Very fun.
Oh,
Yeah.
was that
Very
guy
fun.
was he was great.
Right.
All right, Alice, that's it. Here it is in simple form. How easy is this? Net sales, cost of goods sold, and operating profit. You only have to plug one number.
Fantastic.
Okay. And then on General Mills, it's a lot closer. I think it's like on page 20 something. Was that right? Do you remember, Nicole?
I don't know that one.
You don't have that one memorized.
I
Okay.
don't know.
So anyway,
I know this one because you gave me the pages last time. The other one I had to look for.
Okay. Yeah. So you get this information the same way from General Mills. And then, like I said, think of the write-up. If a student gives me something like Kellogg's net sales increased by 12% each of the last 2 years compared to 4% for Kellogg's, which went down in the next year. Well, that's good information, but give me a reason why. It's not asking too much, just read in there. They'll, when a company's sales go down or up, they love to talk about that. Why? When sales go up, they love to brag in the 10K. Well, we had a sales push and people just love our new peach oatmeal or something. If sales go down, they'll say, well, we had a tough period because of some weather problems and there was a distribution, you know what I mean? So,
right.
What I don't think that, so that's your first page. And I'm just going to bring it up again real quick, if I may.
So the selling, general, and administrative expense is operating expenses, correct?
That's the very definition of operating expenses, general, selling and admin. Yeah.
Okay.
Selling and admin.
Because if that's
Also,
wrong,
make sure you use the proper decimal. Cornelia will knock you down. We want 1 decimal point here.
Okay. Should I add the percentage next to my year? Do you want it like that?
If you know how to do it, yeah. But I'll get this out to everybody. But yeah.
Okay.
Yeah.
I'm terrible with actual spreadsheets on.
No, that's fine. That's fine.
The template.
Okay. So that's a brief look at the FSA. Like you said, just not too daunting once you know what we're looking for. Huh?
Right. I just couldn't even get traction off the get-go, but now that I re-look at it, research.
And this FSA thing is one of these projects where maybe if a couple students work together on it, it helps a little bit. Of course, you have to, you write up your own and everything, but you know where to go.
Right.
Go to the 2 annual reports. Another thing you might Google is something like Kellogg's press release. And you might find something in the middle of the year, a headline from the New York Times.
Right.
Kellogg's loses legal action for $12 billion. And that might explain the operating profits. So, all
Cool.
right, we're
Awesome.
good there, Justin.
Yes, thank you so much.
Let me ask you a question. You don't keep too busy as a public defender, do you?
Super busy, crazy busy. Seems like crime has increased the last couple months for some reason.
Oh.
It was down and now it's back up.
Yeah, no, the public defenders. My goodness, what a tough job, huh?
Yeah.
So I love watching Law and Order. You know that show, right?
Fun, sure.
I don't know how real that is in the courtroom though. But the poor public defenders always getting the hell beat out of them.
Right. Yeah, there's some
They-
similarity.
One episode last week, they put the guy in jail for many years. Did you ever see that one?
No, I don't know if I saw.
He would not reveal his source.
Wow. There have been PDs. Some of my colleagues have been thrown in for a while. Usually
Yeah.
just for a couple days, but still.
Yeah. Well, this guy was sticking to his guns. I'll leave with one silly. It's not a joke, really. Do you remember the Mary Tyler Moore show, right?
Sure.
Remember Ted Baxter?
No, that I don't.
Ted Knight, the guy with the newsmaster on that show,
Okay.
the white hair. Anyway, he was a big buffoon, and he testified in a trial. And the first question was, state your name and occupation. He says, my name is Ted Baxter, and I'm the best damn newsman in the entire Midwest. And afterwards, someone said, how could you say that in court? He said, I had to. I was under oath.
That's a good one. I like it.
All right. Well, I'll let you guys go then, huh?
I have one more question.
Yeah, sure.
Sorry. Okay. Also on the thing that Cornelia put, we also need the accounts receivable turnover and days to collect. And the inventory turnover and days to
How
sell.
could I forget about that? Huh? Okay. All right. Okay, this is in your book. Accounts receivable turnover. Accounts receivable turnover. That's going to be your sales divided by the average AR.
Okay.
Sales. And yeah, so she gave an example of that, right? The template, I mean. Could you share your template one more time, please?
Yeah.
Oh yeah, I'm not.
Okay. So this is
Yes. I forgot the second page. Yeah. So this is from chapter 6. This is from chapter 6. This is from chapter 7. We should have already learned this. Accounts receivable, net credit sales divided by average receivables. Average receivables, what was the balance on January 1st and December 31st? Or you know what I mean? The end of each year. Average amount, you divide it. So if you divide that out, you get what's called the turnover. And we should remember this from chapter 6. The turnover might be 9. Okay. That simply means you're turning your receivables over 9 times a year. 9 times a year, you collect the average receivables. But you go, and I've said this a million times, you go into a meeting with your boss, and the boss says, how are we doing with our receivables? We say, oh, we turned them over 9 times, boss. He or she going to look at you, what are you talking about? So what you want to do is turn that into days. So here, good. Nicole's throwing some numbers up here. Here, turnover of 9 means that they collect cash in 40 days on average, 41 days. This company, from the time they ship their product or perform their service, their customers pay on average in 41 days. Here, with the inventory one, we are figuring out how long it takes to get the product sold. So here, you're taking the cost of goods sold divided by the average inventory. Cost of goods sold divided by the average inventory gives you a goofy turnover here. Why don't you change that 9 to 2 or something, or change 10 to 23? Okay, that's a little more reasonable. So this company really turns some stuff over. It takes them 31 days to sell. This measures how fast you collect cash, how long it takes to sell. And that can be different from each company. And I think what you're going to find is that they're amazingly similar in terms of the receivables.
So
I think, I don't know, Nicole may have already finished this portion, but the companies that Kellogg sells to and General Mills, they're not selling to small companies. I mean, they're selling to the Walmarts of the world. So they've got pretty good receivables. It's Walmart that would have the trouble sometimes. Okay. So
do
that's
we
about it.
do 2 of these, like each of these for both? A
Yeah,
set for
yeah,
Kellogg's and a set
yeah,
for General
exactly.
Mills?
Just copy that down. You know how to use Excel. Copy that down, and yeah, exactly. You'd have one for perfect. You'd have one for Kellogg's, one for General Mills. Okay.
Awesome. Yeah, I would never have been able to do this without this as part of the lecture.
It's a lot of work. What's this worth? 10 points, something like that.
I think
How
it's
much?
20.
20.
Yeah, I think it's 20.
I need all the points I can get right now. Shoot.
Absolutely. That's exactly right. You want to
Same boat.
scoop them all up.
Yeah.
And then it's for 2019. Is that what we're doing this on?
It would be for the most 2 recent years. Yeah. Thus, it would automatically be 29.